Thank you for joining me today for the week ahead for Monday, January the 11th. Today, I'd like to take a look at what's coming up this week. We are seeing the start of the next earnings season come out. We have the bank kicking that off on Friday. We do have some major economic reports coming up as well. I'd also like to focus at the end of the video on inflation expectations because looking at the seasonality and where we are right now, because what we're seeing is the macro variables really having an impact on the marketplace, the different sectors of the market, which ones are performing well, which ones aren't. And we saw that in 2020. We're still seeing that in 2021 as well. So the US dollar, interest rates, and inflation expectations. So today we'll take a look at inflation expectations as well. Before we do that, though, I'd like to take a look at the S&P 500, the performance of the different sectors of the market and the markets themselves as well. So if we take a look at the S&P 500, you can see here we are at an all-time high for the S&P 500. We're above that 3,600 level for the support level as well. You can never complain about an all-time high. The stock market can move higher on an all-time high. It's no reason to be sold at all. Very often that's when investors will come into the market because it's in the news with all-time highs, and so we've once again seen another all-time high. Well, one little concerning factor is we are seeing a little bit of price momentum decline that's taking place for the full stochastic oscillator, which is a bit of a divergence. It's not a major factor as far as that goes. But it is something to take a look at. We might see a little bit of softness in the market overall. If we take a look at the action last week, we did see that big, huge down day on Monday. That's not a record, but it was the biggest down day to start the year in many, many years. Investors were getting a little skittish, a little nervous, which is not positive about the market. Sometimes you take a look at the first few days of the market and say, okay, well, what can come out? What are investors thinking? On the positive note, we did see Tuesday up, Wednesday up, Thursday up, Friday up as well. So after that one big down day on Monday, the market did manage to rally back despite everything else that was going on last week outside of the markets. If we take a look at the different markets as well, so the S&P 500 was up 1.8% last week. We did see the S&P TSX Composite Index at 3.5%. as well, which is substantially above the S&P 500. The Russell 2000 Small Cap Index, almost 6% last week. Now, interestingly, the Russell 2000 the week before didn't perform that well. And so, all of a sudden it became risk on. Investors poured back into the Russell 2000. And it could be a little bit of the small cap effect where the small caps tend to get pushed down in December and then increase in January, except for we didn't see that at all. The Russell 2000 performed well in December. That last week was a little bit weaker, but the last week of December was weaker. And then last week was actually quite strong as well. So that just shows investors really are in a risk-on mode. I've included the emerging markets, which were up almost 6%. The reason I've included the emerging markets they are in their seasonal period. Last week we did see them break above their resistance relative to the S&P 500. So we're starting to see some favorable trends for the emerging markets right now. So something definitely to keep an eye on. If we take a look at major sectors in the U.S. market, look at energy, 9.3% for energy last week. OPEC and Russia had to straighten out their production. Market looked at that very favorably as well. So, and that also accounts for why the S&P TSX Composite performed so well last week, because it has the energy sector has a larger impact on the TSX Composite. If we take a look at the materials, over 5% up. Interesting, we'll look at the difference between the industrials and the materials. And this was not because of gold. Sometimes that's because of gold. We have that taking place, but we didn't really see that taking place last week. Usually the cyclicals will have a tighter performance between the two. We'll have to see if that straightens out. The discretionary sector did quite well last week. Financials up almost 5%. That's because of rising interest rates. Banks benefit from rising interest rates. They have a higher net interest margin. And so that really was concentrated last week in a couple of days where we saw the banks and the financial sector actually perform quite well. Real estate down because of higher interest rates, because the interest rates were a big factor last week. Utilities down because of higher interest rates. Staples down because of higher interest rates as well. So interest rates were a big factor last week in the overall performance. And here you can see what's taking place. This is a graph of the U.S. 10-year Treasury yield. You can see here that very low level back in August, sub 0.6%. For the U.S. 10-year. And what we saw recently was below that 1%. We saw it try and get above 1% quite a few times. And guess what happened last week? It got above the 1%, and it rocketed up higher. So it affected different sectors of the market, such as gold sold off substantially when that took place, because the opportunity cost of gold increases as interest rates increase as well. But the one thing I do want to point out is this is quite a large move that we saw last week. Now, we have seen that in the past. We saw that large move back in June, and then we saw that correction take place. We saw a large move here, and then it settled down. It doesn't mean it's going to keep running up from this level as well, but it is something to watch. We did see that break above 1%, and the market reacted quite strongly to it. The actual yield on, if we're looking at from our RSI and full stochastic oscillator basis, is actually overbought at this point. Doesn't mean it'll turn down here. It just means it's overbought. And when it does turn down, it could be a little bit negative if that takes place, but it could stay above these levels for quite some time as well at the same time. Just watch for the turn down on that. If we take a look at what's coming up this particular week, from an economic report standpoint, we have the inflation rate, core inflation rate coming out. The expectations are 1.6% on a year-over-year basis. And the inflation rate itself is 1.3% expected. Now, these are well below the Federal Reserve's 2% target. In fact, they're using an average target they announced not too long ago. So, huge gap here. And now there is a lag that does take place between money printing or government spending and inflation really starting to uptick. So we haven't had, despite huge quantities of money introduced into the system last year, that really staved off deflation that would have taken place and demand erosion. And so we would have actually had, some of that contraction taking place. So the big question is this year is, are we going to have inflation or deflation? In fact, I'm just coming up with my newsletter for January 2021. If we take a look at that, we can see here, I try and answer the question while I take a look at the variables for this. The 2021 case. So last year, 2020, we all, not all of us, but a lot of us tried to describe the year with different letters. It was a really bifurcation process that was taking place, where different sectors were performing well and some were performing poorly. Well, this year, I think the big question is going to be inflation versus deflation taking place. And some things are going to go up in price and some things are going to go down in price. And CPI, yeah, sure, it's going to blend them and it's going to have an average of that, but there's going to be a lot of argument what's coming up in society, because as I just mentioned, if the government hadn't increased spending, and whether they did a good job of it or not, that's a different argument. But if they hadn't done anything, we would have seen highly likely deflation taking place and real demand contraction taking place. So in my newsletter, I do go in, and which should be coming out the next day or so. If you take a look at what are the deflationary forces, demographics, technology, contracting economy, debt deleveraging, and what are the inflationary forces taking place. I also take a look at the velocity of money coming in here as well, and try and take a look and see what are the factors and what should we expect. Sure, all this money printing and government spending is inflationary, and down the road it would be highly likely that we would see some inflation actually take hold. But is that the case in the short term, especially with COVID-19, more lockdowns taking place, and economic contraction taking place as well? So definitely something to watch out for. If you can get my newsletter over the next couple of days as well. If we take a look back here, we can see here that On Friday, we do have the retail sales coming out on month-over-month basis. We've got a slight downtick. But the big news on Friday is JP Morgan, Wells Fargo, Citigroup, BlackRock. So the financial institutions reporting. So this is really the kickoff, the unofficial kickoff for the earnings season. It's going to be interesting because the banks have been benefiting from these higher rates taking place. And so it has been a positive for them. In December, the Federal Reserve did say the banks could buy back their own stock as well. So I'm not saying that's going to happen now, but investors will be looking for commentary, maybe a little bit around that. But overall, it'll be interesting to see the market's reaction on Friday to the bank earnings, because this can set the tone for the overall markets. Because the banks tend to be, if we see the banks perform well, very often that's the stock market can perform well. Not all the time, but it can be an indicator of that. So something to watch out for. I want to take a look at inflation expectations. Okay, and inflation expectations are important because it's one of the factors that is driving the market, that's separating the different sectors out in relative performance to each other. And it's the big question of the year, as I just mentioned, showed you my newsletter, which should be coming out shortly. But that's investors need to take a look and say, what's happened to the U.S. dollar? What's happening to interest rates? And have a viewpoint on that, and also to inflation expectations. I want to take a look at my book here, 2021 Investor's Guide. You can see here, I mentioned this last time. It isn't available now in bookstores. It's also available online as well. And today I'd like to take a look at, in this case, I want to take a look at break-even. It's one of the few macro variables I include from a seasonal standpoint in my book itself. And you can see here, and basically the break-even is taking a look at calculated by taking the yield on the 10-year Treasury note, subtracting the yield on the 10-year Treasury note that's inflation protected, so TIPS. And basically the difference between the two is the inflation expectation. In this case, we're using the 10 years. So the inflation over the next 10 years is what's called the break-even, which represents investor expectations for inflation. And if we take a look at the graph I've got here from 2003 to 2019, you can see here we tend to see in the first few months of the year, inflation expectations actually increase. And then, I've got here that they really tend to peak around March. You can see a little bit of a benefit from a little bit later on. But really, they tend to decline substantially in May, where they come down. In fact, if I just slide this over and take a look here for inflation expectations in May since 2003 have only been positive 12% of the time. So you do see that really fall down. So if we do see inflation expectations maintaining or stable at this point, watch out for the month of May. Because that's when inflation expectations can curtail. Interestingly enough, that's when the stock market has the weaker 6 months seasonal period for the stock market is in May as well, and you tend to see the stock market perform poorly as inflation expectations decrease, which makes sense. And then once again start to pick up in October as well. And bonds tend to perform better, nominal bonds, from May until the beginning of October as well at the same time. If we take a look and see where we're at right now, in this case, I'm using in this graph here, you can see I'm using the inflation expectations calculated using the five-year inflation swap rate. Now, it's a different way of calculating it. It is for 5 years. It's the same general trend. And the inflation, 5 year is basically a fixed contract for fixed income versus a variable percentage interest rate swap between two commercial parties. And the difference between the rate represents their expectations for inflation. So the trend is also very similar to the way we looked at for the break-even. So this shows the inflation expectations, what investors expect over the next 5 years as well. So you would expect, just like we said before, the inflation to pick up in the first few months of the year. We saw that back in 2017, and then really in April we saw it turn down. In the beginning of 2018, we saw inflation expectations pick up and then turn down, remain flat, and then head lower towards the end of the year. 2019, the first few months, once again, inflation expectations picked up before moving down. And then 2020, they started off the year actually heading down and continued to head down with the pandemic, of course. So something to watch out for inflation expectations. You can track this on the FRED site, the St. Louis Federal Reserve site, for break-even inflation expectations, or the swap rate, either or there. So something to take a look at, because it is going to help determine what's taking place in the market. If inflation expectations are picking up, you're going to see sectors of the market such as value perform better over growth typically. Not all the time. There are other variables taking place as well. So there'll be different sector performances and relative expectations for performance to track. So it's a variable that investors should take a look at, although most investors aren't going to actually invest in inflation expectations, but it's important to take a look at in order to help determine a position about the different sectors of the market, whether value or growth is going to outperform, or financials is going to outperform with higher inflation expectations. You might see interest rates increasing at that time, which would actually lead to helping financials as well. So something to watch out for overall. Well, thank you very much for joining me today as we've gone through a little bit of what took place last week and some of the stuff that may take place this week. And I thought I'd just do something a little bit different with inflation expectations. I'll get back to more of the traditional, here's a sector of the market next week. But I just wanted to provide a little bit of a different perspective. Thank you for joining me today.